Good day, fellow investors. Berkshire is at all-time highs and the new earnings for 2021 came in, Buffett's letter came in, so that's always good to discuss. And in this video I want to explain why I think that Berkshire is always a great investment and that what you can expect, we'll put this into our valuation table, is that you double your money in the next decade, which is not bad from an investment perspective. So let's start immediately discussing the earnings. Pretty straightforward, big diversification business with Berkshire, and what you have to focus on when it comes to Berkshire are the operating earnings. So for 2021, Berkshire made $27.5 billion. That's what the business itself did. You have to disregard this investment gain of $61.5 billion because that represents how much the stocks that Berkshire owns went up and down. If stocks go down next year, then this will be a negative number. So better focus on the 27 billion plus on the earnings that these companies make and what is Berkshire's cut in those companies. If you look at Apple, Apple makes about $100 billion. We've made the valuation for Apple stock, and 5.6% of that is owned by Berkshire. Thus, Berkshire's cut in Apple's earnings is about $5.6 billion. If we sum things up for Berkshire's holding, that should be around $8 billion for the holdings, perhaps even a little bit more, but let's stick to 8 billion for conservative calculation purposes. Before going to valuation, there is again something very important that Warren Buffett mentions in the letter. The most important thing in this short letter is that the balance sheet includes 144 billion of cash and that they will always keep around 30 billion of cash and cash equivalents on the balance sheet for insurance and safety purposes, which means that he has $114 billion available to invest. If he could invest that with a 10% return, that would add $11.4 billion to Berkshire's earnings. But he has to find the way where to deploy that money. That is something he didn't yet find over the last years. He's doing some repurchases, but then also it depends on where Berkshire's stock price is and whether it's best to reinvest, wait, or do repurchases. During the past 9 years, they repurchased 9% of the shares outstanding, so that is a 4.5% repurchase yield, and he spent 51 billion for that. And then he also says that as of February 23, so they repurchased 1.2 billion in, let's say, less than 2 months. So if they continue like that, their repurchases will be a little bit lower than in the previous 2 years, but as they say, it always remains price dependent. So let's put that into valuation. So we have said $27.5 billion of operating earnings, plus let's add $8.5 billion of earnings that should be there but are hidden because done by other companies where the earnings are not consolidated, divided by 2.2 billion, that is the number of shares outstanding, and I come for an earnings level of Berkshire per share, which is Berkshire.B in this case for easier calculations, of 16.27. And now, if they keep growing at 6%, then over the next 10 years, if the terminal multiple remains around 20, then the intrinsic value of Berkshire.B share is $211. And if you look at it from that perspective, for a 10% return, it was, let's say, fairly valued about a year ago, but then it really boomed 40%, which means that your expected return is not more 10%, but likely now it is lower and should be around 7%. So 279, even a little bit lower on this expected growth. But then you expect a discount rate or an expected return of 6 to 7%. Perhaps my growth rate is a little bit conservative, so 8% could be a little bit better, especially if the $100 billion are deployed into new earnings. So in that case, and if the terminal value is at 25, then we could say that Berkshire is fairly valued at current levels for a return of around 10%. In the worst case scenario, I have put just 5% growth rate, lower terminal multiple, and then you have 50% downside, but this should be something that, okay, long-term Berkshire investors know that can happen anytime, but something temporary over the stock market cycles. So all in all, I expect that from these levels, if all things are going well for Berkshire, which are very likely, the balance sheet is a fortress, everything is good, you could expect this to double over the next decade, so 6-7% long-term return, which is nothing bad. Of course, if interest rates go higher and investors expect better returns, then one should not be surprised to see the stock go back to the levels that it was there a few years ago. So that's the risk and reward. Of course, if you're a long-term investor, then lower Berkshire prices would make Buffett happy, more buybacks, and also you happy because you can add a great business to your portfolio at lower prices. I always enjoy Buffett's letter, but this time it is very short, so he really points out a few key things that they own, what they own, why they own it, and what is there to be expected. A lot of thank you notes, so not really the Warren Buffett letter we are used to or we enjoyed over the past 50-something years, but he is likely getting a little bit older. Berkshire is Berkshire, so this is what you can expect over the long term. And the key is that you see how the risk, the reward, and the expected return, the earnings, the 36 billion, and then reinvested, and you can see the reinvestments, how they are doing it. If you go to Berkshire's investor presentation for Berkshire Hathaway Energy, then you have 100 slides explaining what they do, how they do it, what's their plan, how they reinvest the cash flows into creating a better and better longer-term standing organization, which is pure Berkshire. So it's unlikely that you will lose money in the long term with Berkshire, especially if measured in US dollars, so diversification. So it's like owning an index fund, no fees, and very smart people and a great culture managing the money for you. Unfortunately, as the stock went up, the returns are mathematically lower. But apart from that, nothing wrong with Berkshire. You can see how they reinvest the free cash flows that the energy business is doing, and this will compound like Berkshire compounded in history, and that is about it. Thanks for watching. Check my other S&P 500 stock analysis that will be in the links in the description below. Subscribe if you haven't, and I'll see you in the next video.